right, let's get straight to the numbers. It's Wednesday, December 17th, pre-market.
Yeah.
What's the implied open telling us?
Total hesitation. I mean, we are just stuck. The market's message is loud and clear. It's waiting. We're in this choppy early consolidation phase.
Give me the specifics. Where are the futures?
Okay, S&P futures, the ES, basically dead flat. It's hovering just a hair above 68.65. The Dow's showing a little weakness, maybe down 0.1%.
Intact.
That's the only glimmer of green, and I mean a glimmer. The NASDAQ, the NQ, is up a fractional 0.1%, right around 25,419. It's a market that is just desperate for direction.
Okay, so when we see the indices pinned in a range this tight, it means you've got two big opposing forces basically canceling each other out. Let's unpack that. What's the core tension here?
It's a classic conflict. On one side, you have these undeniable economic headwinds just mounting. We're seeing consumer sentiment fall again.
And it's important why it's falling.
Exactly. This isn't abstract. It's anxiety over personal finances. It's the painful, constant drag of higher food prices hitting people's budgets. That's real Main Street caution.
And you have to layer the manufacturing picture on top of that.
You do. Add the industrial side to the equation. American manufacturing is now in its, ninth straight month of contraction?
Ninth month. And the PMI just hit a 4-month low.
Right. So that 9-month stretch, that's a significant, undeniable drag on the actual economy. It puts a hard ceiling on any kind of broad structural rally.
Okay, so that's the gravity. That's what's pulling us down. But something is obviously keeping the market from sliding. What's the counterweight?
The offsets are almost entirely psychological. They're forward-looking. Wall Street seems, stubbornly anchored to two huge themes.
AI and the Fed.
AI and the Fed. Relentless capital flowing into AI infrastructure, and this deep-seated hope for future monetary easing. The idea that the Fed has to pivot eventually, that rates will come down, is keeping a floor under these high valuations, even while the hard data looks this soft.
So let's connect that to the single biggest data point moving capital right now, the cost of money. The 10-year yield is at 4.17%, ticked up another 3 basis points this morning. For our listeners deep in the tech trade, why does a fractional move like that matter so much?
Because it's a fundamental change in the discount rate. A rising 10-year is a direct, very powerful headwind for these long-duration growth stocks.
It's basically a math problem hitting their valuation.
It's exactly that. When yields go up, the cost of capital goes up. So the future earnings of these companies valued on promises years down the road, they get discounted back to today at a much higher rate. It just shrinks their present value.
And for institutional money, it creates alternatives.
Absolutely. Think about it from a portfolio manager's perspective. Higher yields suddenly make less risky assets like short-term bonds look a lot more attractive. And when that alternative looks better, capital has to rotate out of the high-risk tech trade. It just puts this disproportionate pressure on those growth names.
And the dollar's not helping. The DXY is up a bit, trading around 98.60. Why does an investor focused on, say, U.S. tech need to be watching the dollar index?
It's a nasty currency translation headwind. A lot of these huge tech firms are really multinational companies. They get a massive chunk of their revenue from overseas.
So a stronger dollar hurts them.
Right. When the dollar strengthens, those euros and yen and yuan all translate back into fewer U.S. dollars. It compresses their global revenue numbers, and, it often forces them to guide a little more cautiously. It's a real pressure on the bottom line.
Okay, let's pivot to where the money is moving. If the broad market is stuck in neutral, investors get hyper-selective. So individual catalysts become much more powerful. Where's the conviction flow this morning?
Technology. It's still technology, but specifically the AI and data center ecosystem. That's the clear alpha sector in the pre-market.
But this isn't just hype.
No, that's what's so fascinating. This isn't a pure hype rally anymore. The momentum is earnings-driven. You have this unprecedented investment cycle into AI that just keeps reinforcing the trend. These companies are basically decoupled from the Main Street consumer. They can outperform even if the broader economy stays soft.
And we've got two perfect contrasting examples of this selectivity in the pre-market movers. On the downside, Tech Innovations Inc., TII, is down 3.5%.
And that's a direct reaction. They delayed an AI product launch, blamed the usual supply chain snags, and it's dragging on the whole semi space.
Clear cause and effect.
Exactly. And on the flip side, you see just how powerful one catalyst can be with Global Pharma Corp, GPC. It's up 5.2%.
All of the FDA news.
All in that expedited FDA approval for their oncology treatment. It just shows that in a market like this, good company-specific news can completely override the macro gloom. You get these immediate, powerful flows.
All right, let's drill down into the three big conviction plays that really define these market themes. We have to start with NVIDIA, the undisputed AI leader. What are the levels and what's the debate here?
With NVIDIA, the catalyst is just continued dominance. We saw great follow-through from the Nemotron 3 software news, and there's a huge early demand for the new H200 data center chip. The structural ceiling the level bulls need to break is 258.
258, that's the consensus price target.
It is, and it's supported by things like getting H200 export approval for China and all the anticipation building around the next-gen consumer chips, the RTX 50 series.
Okay, but the valuation is a huge concern for a lot of people. Where's the floor? What's the level that signals real trouble?
The floor, the breakdown level, is 170. It's a critical old resistance level that became support. The whole bear case is about valuation risk. I mean, the stock trades at an insane multiple. Any hint of a slowdown in that triple-digit growth or new worries about export limits, and you could see a really fast, aggressive move back down to that 170 level.
All right, let's shift gears to a totally different growth story. Eli Lilly, LLY, the face of the whole GLP-1 revolution.
LLY is just a pharma powerhouse right now. It was built on Mounjaro and Zepbound, but the current momentum is all about the phase 3 results for retatrutide.
Their new experimental weight loss drug.
Right, the once weekly, and it's showing superior efficacy. So the valuation hurdle, the level that marks new highs, is 1050. That's driven by the idea that retatrutide could be the best-in-class drug and that Mounjaro could get expanded prescribing for cardiovascular benefits. That opens up a massive new market.
But wait, if the efficacy data is that strong, is the safety risk really a major overhang? What's the downside case look like?
That's the question, right? The floor, the level that would signal a failure of this recent momentum, is 950. Efficacy is amazing, but there are some early safety signals, specifically reports of dysesthesia, which is a nerve sensation issue.
So if that gets worse,
If those signals escalate or you get a regulatory delay or even just government pressure on pricing, that 950 technical floor could get tested very, very quickly.
finally, Tesla. TSLA, high volume, high drama, and a stock that's often driven more by narrative than by car deliveries.
It is purely an AI chapter stock at this point. The entire bull case is built on the robotaxi and the Optimus robot. They're trying to sell driverless tech as the real high-margin growth engine of the future.
And the level for that narrative.
The ceiling to watch is 290. That's the price that aligns with really aggressive 2025 production targets and FSD breakthroughs. It's the level that supports those wild analyst forecasts of a potential $2 trillion market cap. But it all depends on the AI story working.
But the reality is their core EV business is facing brutal competition. So what's the technical floor if that AI narrative starts to crack?
The key floor is 180. That downside risk is all about the core business-intensifying competition in China and Europe, declining registrations. If the market loses faith in the robotaxi or Optimus timelines, if there are any big delays, that 180 floor is in play. And there would be a major technical breakdown, confirming that capital wants revenue now, not AI bets later.
Okay, so we have the macro forces, we have the conviction plays. Now we need the roadmap, the lines in the sand that tell us if we break out of this consolidation or stay stuck. Let's start with the S&P futures, ES, trading near 68.65.
Your critical support zone is 6790 to 6800. That is the line in the sand. It's so important because it captures the 50-day moving average and a bunch of prior pivot points.
So a hold there is constructive.
Right. A hold above 6,800 keeps the bullish bias intact, but a decisive breach, especially on high volume in the first hour, that signals a pullback. Your next target immediately becomes 67.64.
And on the upside, what do we need to see to confirm a real breakout?
We need to clear the resistance zone between 68.80 and 69.08. That area has rejected every advance for the last week. A clean break and hold above 69.08, a 15-minute candle closing above it, that signals fresh momentum, and the next target is 69.50.
Let's switch to the NASDAQ 100, the NQ. It's testing resistance right now around 25,419. If that AI enthusiasm fizzles out, where's the floor?
The major support level for you to watch is 24,910. That's a huge psychological and technical floor for the Nasdaq. If buyers don't show up there, a sustained break could open the door down to 24,682 very quickly. It would confirm some pretty aggressive profit taking is underway.
And for the bulls, what's the breakout number on the NQ today?
You have to clear the resistance between 25,430 and 25,660. We're right at the bottom of that range now. Clearing and holding above 25,60 is the strong, decisive signal you need to confirm a true breakout and a fresh leg up for tech. If we can't clear 25,430, we're probably just stuck in the tight range. So, to put it all together, we are squarely in an early consolidation environment. It honestly feels like a potential liquidity trap. You have both indices testing resistance, but there's just no conviction for a breakout because you're perfectly balanced between those real economic drags and the, forward-looking hope for a Fed pivot. Expect more of this sideways chop until one of those forces wins.
And that brings us to our final thought for today, and that's the risk of the pain trade. If this 10-year yield keeps spiking, if capital really does start to reassess risk, the pain trade for many retail investors is missing the rotation. It could be fast, and it could be sharp. Capital will bolt from long-duration growth tech, those names that need low rates to justify their valuations, and it will pour into value or short-duration fixed income. You're watching a fundamental cost of capital shift happening in real time, and you absolutely must factor that risk into how you're sizing your high multiple positions today. Thank you for joining us for this deep dive into the pre-market data.